Welcome to Subramani. The year 2022 was not really a very easy year for people to invest, right? Interest rates went up in the US, interest rates went up in India, so you took hits in your bond portfolio, right? So similar, your equity portfolio didn't do well. The 25% fall in S&P, 33% fall in the Nasdaq, right? And we all of us had put a lot of money in FANG and in China and all that, and we took a hit. China also recovered fast. So if you were in global funds, you lost money. If you were in Indian funds, you did not lose too much money, but you may not have made too much money. So that means 2023 is going to be perhaps more difficult than 2022. So what can you do to prevent too much of heartburn and bad losses in 2023? So first of all, decide not to sell in panic. Will 2023 create a recession? Will there be a problems? We have no clue. We need to be just prepared for it. So maybe 2023 will be better than 2022, but maybe 2023 will be worse than 2022. Will India do well? Well, India could do well, but remember, we are quite high in the emerging markets. We are still not done too badly compared to many other countries, including US, China. They've all fallen dramatically, which means they will recover also well. So a lot of world money, world attention will go to those markets because they have fallen. So once the market falls, a lot of money rushes in, contrarians, etc. rush in to buy. They may not rush in so much into India because India has not fallen enough, did not fall enough. But remember, when the FIIs pulled out, the markets didn't fall, which means the FII is going to look and say, well, this market has not fallen, so maybe I should allocate more. So if the FII start allocating more, let's say even debt, if they start allocating more to India, which means India interest rates will be frozen at a particular number. Let's say gilt reaches 8% and gets frozen there. Maybe it will stay there longer. Maybe it will not come down as fast as we think. Maybe all of 2023 and parts of 2024 we will spend with gilt at 8%. But it is also possible that some money comes in to invest in India in debt that brings the interest rates lower. That is also possible. But also remember, a heightened interest rate, but for a long time, means the equity guy is going to ask for a higher risk premium, so which means equity prices will go up. It's important to realize that if interest rates go up, it is bad for the bond market in the short run, but in the longer run, slightly longer run, it is good, because if debt investors demand 8% or 9%, let's say 8% is gilt, so they demand 9.5%, 10% from corporate bond funds and 11% from credit risk funds, which means the equity guy is going to ask for 14-15%. He's the guy who is taking the maximum amount of risk. So he or she in equity will want higher returns, so therefore the markets will have to do well. Companies will not be able to come into the market to raise money unless they start promising very good growth or very good returns or something like that, right? So that will happen. But it is also possible that if the other markets are doing well, say US, China are doing well, a lot of money will get diverted there, and we may not get adequate money. If we don't get adequate money, we will be more dependent on our SIPs, and our SIPs are booming. So therefore markets could do well. But one does not know exactly where we are in the market. Will markets do well? Will markets do badly? We are all guessing, right? So what should you do? You should look at your asset allocation and see whether you are happy at that asset allocation. Are you able to sleep peacefully, assuming there is a 20% fall in equity market? So maybe you got 5 crores in equity markets. If it becomes 4 crores, how will you feel? Now just remove one figure. You've reached 50 lakhs in your equity portfolio and you're very happy with it. Now if it falls to 40 lakhs, how will you feel? Bring out all those feelings. It's not easy to imagine the feeling, but it actually, when you write down in numbers and sit with your family and discuss, you might realize that maybe you did not have an appetite for so much of risk, but you took risk because you thought the market was booming. Market has boomed, your portfolio has increased. Now don't get foolish to think, see, I've become a brave man. You didn't, you got lucky. So then maybe some reallocation of assets, asset reallocation is necessary. Maybe you book some losses and pay less taxes. If you've got too much of income in the current year, don't book your capital gains tax, because your capital gains tax still attracts surcharge. right? So do all that cleaning up operation before March. Make sure that you book your long-term loss, short-term loss, whatever it is, claim the set off. Be prepared with all those things, right, for 2023. If you can get your losses, just book it, because you will be able to take a set off. So check out all that, do all that, and then ask yourself, am I happy with this asset allocation? If the answer is yes, then continue. Or if you say, oh no, I need cash in 2024, then it may be a great time to be putting 80-90% in floating rate fund of the money that you require. That will grow, and the other amount you can always take from your equity. So this is how you get prepared for a bad year, possible bad year in equity markets. I'm not saying it will be a bad year, but if it's a bad year, be